Good morning and happy Friday. Jordan Keck here, your complicated deal guy with your weekly market update. Interest rates unfortunately continuing to move higher this week from 6.68% to 6.85%, getting close to that 7% range for top tier scenarios. These are clients with 800 credit scores, 25% down payment purchasing on high dollar prices. Includes a little bit of lender fees in that, so you're seeing some people doing buy downs or government loans are going to be lower in the sixes. But somebody with lower credit scores, still on conventional, may be touching quite a bit into the sevens here. And as far as our weekly mortgage tip, wanting to talk, been having a lot of conversations recently with people about the Oregon Bond or the Oregon Flex programs for down payment assistance. These are some great programs that often allow you to get anywhere from 4 or even 5% in some cases for down payment assistance, and are used to be able to have to reduce the amount of cash people come up with. One of the trade-offs most people are getting, though, is that the closing costs are quite a bit higher. Not uncommon to run in the $15,000 to $19,000 range for these. That can still be paid by the sellers if the seller is willing to do that, so it's a negotiating point. But not having to come up with down payment and having some below market interest rates has been helping a lot of people get into homes that otherwise would not have been able to. One thing that had recently came up, though, is as far as the forgiveness. Now, if you're under 80% of the area median income, you may be eligible to have the down payment assistance portion forgiven rather than just being a loan. However, it used to be forgiven after about 5 years and then pro rata. Now you have to have it for the entire 30 years before it is forgiven. So not nearly as favorable as it used to be. So if you're hearing clients talking about getting it forgivable, there's a lot of caveats on that one. And especially since the Oregon Bond program does not allow you to rent out the property after you buy using that program, you have to refinance or pay it off, in which case the forgivable portion would have to be repaid. So a little bit of a gotcha. They've changed since recent years. So always wanted to keep you up to date on what's changing in those programs. As far as news this week, oil prices moving above $91 a barrel, which is renewing inflation fears. And this is the biggest reason we saw interest rates move up this week. The reason for it, the reports of Houthi attacks on tankers off the coast of Saudi Arabia. So the U.S. also renewed threats to escalate strikes against Iran, including moving bombers, stealth or supersonic bombers into Iran. There are now oil disruptions in the Strait of Hormuz, the Red Sea, and the Caspian Sea, all causing oil prices to rise and continue those inflation fears. The U.S. also announced additional tariffs against Canada this week and several other countries. Specifically with Canada, they placed a 50% tariff on over 500 Canadian goods, as well as sweeping tariffs on the majority of imports that could take effect over the next week or two. These will largely be replacing the existing 10% tariffs, increasing inflationary pressure, and the bond market responded after this announcement, saying they did not like it. Cotality reported Q1 equity in their homeowners quarterly homeowners report that equity for mortgaged homes rose to almost $18 trillion. And this is just equity for homes that have a mortgage on them. Total equity across all homes, including those paid off, is roughly $34 trillion. The average homeowner with a mortgage has about $311,000 in home equity, and only 1.9% of mortgage properties have negative equity or are underwater, just a little over 1 million homes. And for perspective, that number peaked at about 26% in Q4 of 2009. Next, we have ICE's home price index for July showed home prices up 0.26%. Since the beginning of the year, they're running at a 3% annualized pace of growth, and year over year, home prices are up 1.7%, an increase from 1.3% in the June report. And lastly, new home sales, so sales of brand new homes or the homes that are going to be started or under construction, rose 1.6% for June, stronger than estimates. This is a seasonally adjusted annualized rate of 628,000. May was also revised stronger, making the report even stronger than the expected headline made. Most of the sales were driven by lower priced homes, causing the median home price to drop 3.3%. This doesn't mean that home prices are going down, it just means that more homes sold in the lower price ranges than the higher price ranges. Hopefully you have a fantastic weekend here. Have a great one. We'll see you next time.